Good afternoon. My name is Jonathan Levin. I'm an opinion columnist with Bloomberg Opinion, and I'm here with two colleagues, Matthew Winkler, founder of Bloomberg News and editor-in-chief emeritus, as well as my colleague Allison Schrager, economist, writer for Bloomberg Opinion, and author. We are here to talk about a package that we put together that's out today on Bloomberg.com at Bloomberg.com/opinion. You can also find the package at our @opinion handle on Twitter. The idea of this project was today's the State of the Union, and we wanted to look as objectively as possible at how Joe Biden is doing by the numbers. So, the question goes out to a series of different opinion journalists, right? We value a diversity of opinions here at Bloomberg Opinion. So the question goes out, here's this metric, take a look at it and tell me how Joe Biden is doing compared to his predecessors. And so we've done just that. And we are here, the three of us, this is not the whole group that contributed to the package, but the three of us to talk about some of the key measurables for the Biden presidency: inflation, inequality, and markets. And so I want to start with the first one because I think it's sort of taken up all the oxygen in the room, at least for the past couple of years, and that is inflation. And Matt Winkler has written on inflation. I've put the graphic that accompanies his piece up on screen here, and the story essentially goes like this. In 2023, in 2022, under Biden, we saw inflation surge to a four-decade high of 9.1%. But since then, it's come way back down, and it's now just 3.1%. So, Matt, let me just ask you, what is your story for inflation? How did it happen, and where do we go from here?
Well, the punchline to that very dramatic trajectory that or roller coaster that you just highlighted, is that the resulting disinflation that we're seeing since that peak in June 22, and it's occurring while the gross domestic product expanded 3.2% in the last quarter. It's unmatched, by the way, resulting disinflation in modern history. And it's the opposite of the 1970s, more importantly, because if you recall, when inflation did in fact accelerate as it did from 21 into 22, there were many comparisons with the so-called runaway inflation of the 1970s. And in fact, unlike that inflation, which took 8 years and 5 months to subside to 3%, as you just highlighted, this inflation that we had went from 9.1% to 3.1% in less than a year. And there's a bigger perspective here, which is that unlike in the 70s, we have the benefit now of a $26 trillion US government bond market. That's a lot of people. It's a lot of money and it's a lot of people. And at no point in the Biden presidency, at no point in the past 3 years, did the bond market ever show us that inflation would accelerate and keep going, from coming out of the pandemic. In fact, the bond market said it will be, I won't use the word transitory, but it won't be for a very long period. And the reason why we know that is when we look at the bond market, we can see a couple of things. There's something called the 2-year break-even rate, which is essentially comparing short-term US government securities to long-term government securities, in this case, 2 and 10s, 2-year securities and 10-year securities. And at no point did that break-even rate ever get to a level that suggested inflation was a permanent problem, a perpetual problem. In fact, it was just the opposite. The bond market never lost confidence in the Fed's ability to rein in inflation expectations, I guess is the best way to say it. And so here we are. So it's a relatively benign outcome. Part is always if you like, the most frustrating, only because you want to get to 2%. The bond market is saying that is, in fact, where we're going before the year is out, that we will get to the Fed's target of 2% or just a little bit above that, 2.3%, probably by November. We know that because, again, we can look at things like inflation swaps. These are, if you will, instruments, financial instruments that enable us to see what people in the $26 trillion bond market are doing every day. And for the most part, inflation swaps have been the most accurate predictor of where inflation is going, where it's going to be. And so based on that, we should see, 3.1 inflation, 3.1% inflation by July, 2.3% inflation in November. And the break-even rate shows traders' expectations for average inflation over the next 2 years to be 2.8%. That's 60 basis points lower than a year ago. So it's good news for Biden for the most part. Prices still are elevated, but the big price increases that we saw are gone or likely to be over.
But it has been a roller coaster, of course. And I wonder, to what extent do you think that the administration deserves much or any of the blame for the inflation that took hold in 2021 and 2022? And conversely, to what extent do they deserve credit for making it go away, man?
So being someone who relies on Bloomberg, as you would expect me to, and data compiled by Bloomberg, I defer to the Bloomberg. And the Bloomberg terminal shows me that the bond market never showed a lack of confidence either in the Fed or in the Biden administration, for that matter. If the Biden administration was irresponsible, as so many very prominent economists initially suggested, with its various acts, Relief Act to begin with, but lots of other ones, Inflation Reduction Act, the CHIPS Act, and so on, then the bond market would have showed you that lack of confidence. And we used to refer to those people as the bond vigilantes, and we really didn't see them in any significant way in this period. What I do think is perhaps missing in a lot of the conversation is that what we went through coming out of the pandemic is not altogether dissimilar from, say, the return of, you will, service people, servicemen, armed forces after the Second World War. We had a big inflation then at the end of the Second World War. We were making planes and tanks. We weren't making cars, and people wanted to buy cars back then, and they couldn't get them right away because the factories weren't set up to do that right away. And so there was a sudden acceleration of prices at the end of the war, when the war ended. And once factories got back to where they should be, that inflation, in fact, subsided dramatically. And I think that there's a real parallel to what we experienced coming out of the pandemic with the supply disruptions. And I will say this, that some very famous, very bright people got lots of attention saying the Fed was behind the curve and the Biden administration was irresponsible for spending a lot of money coming out of the pandemic. And I will say that, there were some very prominent women economists, if I might say, who said, starting with Gina Raimondo, said, look, 80% of this is supply disruptions. Janet Yellen said much the same thing. Claudia Sahm, who's a Bloomberg columnist, said much the same thing. They don't get a lot of credit for being right, but actually they've been right. They've been more right than the people who were screaming that Biden was irresponsible, the Fed was behind the curve. and we were going to get a recession by now because they were so irresponsible, because the Fed would have to rein in all this inflation. And in fact, as you well know, the good news is that maybe because the Biden administration spent so much money when it did to get this economy moving again, we didn't get the recession, that we were investing in America, that we got a GDP that we have, 3.2% last quarter is pretty impressive. And we still have disinflation. And, one of the benefits of the past 3 years is that and this is according to Fed data, if you look at um, all income groups, across all income groups, going from the lowest, it's more robust at this point than in any period in the new century, which is saying a lot. And the fact that we didn't have a recession, the uninsured rate is at an all-time low. Unemployment right now, month over month, I think is the lowest since I was 10 years old, and I'm a graybeard, so that's saying a lot. And to be able to see all that, experience all that, with inflation now approaching what the Fed would like to see going forward, which is the 2% target, is pretty good. So I think the Biden administration actually looks pretty good here. I don't think they deserve any kind of criticism for what was done from a policy perspective since 21. And I certainly don't think the Fed actually has been irresponsible either.
Allison, how do you think about the trade-offs? In 2021, we did a lot of stimulus. The long and the short of it is that, as Matt said, some people came out and said the stimulus itself is going to be is going to drive inflation, and then of course we got inflation. It's very, very hard at this point, in my mind, and I think in probably in Matt's mind too, to think that supply chain snarls were not a major precondition for the inflation we got. But what role do you ascribe to the stimulus in maybe at the margin making the inflation a bit worse than otherwise?
Yeah, I mean, I think even the Larry Summers of the world agreed that supply chains and supply shortages were a big part of inflation. I think there was also a concern that we did pour some fuel on that fire, and I think the concern amongst a lot of economists wasn't just that; it's that when people a big part of what inflation is inflation expectations, which in this chart shows that the bond market stayed pretty measured about this, is that when people expect inflation, you get inflation. And that the concern was once people started experiencing inflation, their expectations would change. So I think the Fed was a bit behind the curve. And certainly the last stimulus was, definitely more aggressive than it needed to be. And probably, I mean, I think the estimate's still out, but I think Jason Furman put, like 2 or 3 percentage points on the how generous the stimulus was. So we would have had inflation anyway, but it was worse. But the good thing the Fed did, which I think we should all be so grateful for, which I think this chart shows really beautifully, is that once they realized that they had to do something, their communication was very strong. It was very consistent. They understood the importance of setting expectations. So the bond market, I think what's really extraordinary about this picture to me is that how good the bond market has become at predicting inflation, because traditionally in the 70s, they weren't at all. And it might be that, as I said, we've got better monetary policy, more consistent monetary policy, or I don't know, luck. Where we are seeing, as I said, consistent expectations, and those expectations being self-fulfilling. So, I mean, I think mistakes were made, but so far, again, it's hard to know where things are going, what this last mile of inflation is going to be, is that we eventually did get it right. And as we'll look at some other things with wages, I mean, there was some damage done, and certainly people might now have a different relationship with inflation than they did before. I think we see expectations, while they are pretty consistently going back to 2%, we also see a bit wider range of expectations, and that suggests that there's less certainty and maybe less stable or well anchored expectations than we had before. But I think the next year or so will definitely be revealing.
All right. Well, let's go to the wage discussion here. I think that's partially relevant to what you wrote about, Allison, in inequality. We also have a great section from Carl Smith about what's going on in wage trends. The long and the short of it is real wages are a function of two things: how much you're making on a nominal basis, and what's going on with your costs. And so while U.S. labor enjoyed some pretty impressive nominal wage increases around 2022 or so, it was essentially crushed by the inflation. Things have now caught up, and you might attribute to some of the positive trends that we're seeing in real wage growth in part to productivity, many other factors. But the fact of the matter is, people are now seeing real wage increases. Is this are we in a sustainable real wage growth environment at this point, Allison?
If the job market stays strong, it's really tight. I mean, particularly, even one of the reasons we're seeing big wage gains on the lower end of the income spectrum is there's a real labor shortage in that area of the labor market. And as long as the labor market stays strong and people have jobs, yeah, I think so. Particularly as inflation continues to go down and people are getting raises. I mean, we could have in 2024, I said, assuming nothing bad happens, and you never know, and that might have nothing to do with policy, just bad luck. I think, yeah, we'll see some real significant wage gains that we have. But I said, I think before there were, real wage declines, and I think that's sticking in a lot of people's memories, and even if things are getting better now.
Yeah, but the question is always like, better against what baseline? And the fact of the matter is, even before this entire pandemic episode, like, wage growth was pretty anemic in the United States of America. It was not great coming out of the great financial crisis, and as you rightly say, we don't know where we're going precisely, but if this sort of wild mix of experiences and this very interesting policy mix that has come as a result of all of this ends up lighting a fire under real wages, do you think that Bidenomics ends up being a resounding success because of that?
Well, I think Tyler Cowen had a really nice column a couple of days ago about this, that, we really don't know for a while. I mean, a lot of what Bidenomics does has very sort of will play out over, a decade, as well as, the costs of it. We'll see, whether or not it becomes a big drag on the economy. This much spending depends on the future of interest rates, and if interest rates fall or go down or go up. But it could. I mean, as I said, I think it's too soon to know either way, because the nature of Bidenomics was very sort of long-term investments in the economy that will, take several years to really play out. I mean, we are seeing already that, building these factories have created a lot of construction jobs, not so much manufacturing jobs yet, but obviously it's too early to really tell. So I guess the jury's still out, or as Tyler pointed out, this is at great cost and more debt. So whether or not that becomes a problem will really depend on the future of interest rates.
Yeah, Matt, in your framework, how are you thinking about this?
Yeah, I mentioned Claudia some, and in deference to her, I should summarize, what she's been saying, and I think it's very compelling. Bidenomics has not, to date, unfortunately, been discussed maybe in the appropriate context, is her view. And the proof is everywhere that the American Rescue Plan kickstarted what is a record labor market recovery. That's a big deal, as Biden would say. Why is it a big deal? In the whole discussion coming out of the pandemic, focusing on the Fed in particular, there was very little talk about the labor market. What's happened since 2021 is the value of workers' paychecks are up 22% since Biden took office in January 21. Now, that exceeds the rise in prices by almost 5 percentage points. Again, I'll say that again. The rise, in wages exceeds the rise in prices by almost 5 percentage points. That reflects pay increases, more hours worked, more jobs. Higher prices is frustrating for everyone, obviously, and certainly a hardship. But more money means that most Americans are making ends meet, and we don't have to wait for evidence of that. It means that Americans are doing really well, and that's evidenced by consistent strength in consumer spending. The important reason is that far more people have paychecks now than in 21, including those who are typically stranded, on the sidelines of job markets. So, for example, the highest share of women in the prime working years, or 75% of jobs. Black men and people with disabilities also made historic gains. So, in total, there are about 11 million more people with jobs under Biden, and these are good jobs. So full-time work was the first to rebound after the recession. Part-time work has followed. I don't know, something like less than 16% of the people who are working part-time say they're doing so due to bad economic conditions or an inability to find a full-time job. So you look at it that way, already you can say, Bidenomics is a success. It's doing very well. As was mentioned earlier, the better part of Build Back Better is also having an impact. It's led to higher earnings, more job opportunities for low-wage workers. It reversed a quarter of expanding inequality over the past 4 decades. That was, I think, University of Massachusetts Amherst professor who showed that in his research. I would say Bidenomics helped ensure there was work to do, often with better pay. And then we got the Chips and Science Act, which subsidizes manufacturing of semiconductors inside the U.S. The Inflation Reduction Act, which includes financing for clean energy. That's going to promise to create manufacturing jobs. Here's hoping it ultimately ease the climate change challenges we have. So I guess, in summary, I would say they did a pretty good job figuring out what needed to be done and took advantage of this massive problem that was the pandemic.
Sure. I think early on, a lot of people tended to look at big fiscal strictly from an inflation question standpoint. And I think that it's almost always the wrong way to go about things if you're focusing on just a single metric. Policy impacts you across so many fronts. And you can't think about inflation impacts without thinking about the labor market and the fact that we seem to be in a decent place in terms of real wage growth. We seem to be in an encouraging place in terms of productivity. Those have to be good signs in my mind.
Yeah, and look, here's the thing: when inflation suddenly accelerated, left out of the conversation, and by the way, the whole notion the Fed was behind the curve was the fact that Fed has 2 mandates, right? One is obviously inflation, but the other one is employment. And they're both important. One is not more important than the other. They're both important. And so some economists have said, okay, by not raising interest rates until 21, the Fed was waiting for us to get to a level of employment that resembled where we were pre-pandemic. And I don't think there's anything wrong with that. And in hindsight, it looks pretty good, which is why, I, for one, would say the Fed was not behind the curve, given that it has 2 mandates. It was paying very close attention to what it was meant to do, which is if you keep people employed, you're going to have a lot more of a cushion when you do raise rates than if they're already unemployed.
Yeah, fair enough. Let me take the opportunity to pivot a little bit to inequality, which is of course related to what's going on in labor market dynamics. And I want to find Allison's contribution here in the package. Allison, I'll send it over to you to tee us up here. What's going on with inequality during the Biden administration?
Well, I mean, inequality has narrowed. I guess that's the good news. The bad news is, at least through 2022, it largely narrowed because everyone's real wages fell. They just fell less for lower income people. Again, they faced a tighter labor market than they had in a very long time. Although it is worth noting that while women are going back in the labor force like never before, men are just barely where they were pre-pandemic, which have been falling for years, which is troubling. But in the last year, as we mentioned, real wages have finally gone up. They've gone up quite a bit for low earners, which is fantastic. But unfortunately, they're up just a tiny bit for a median worker, especially when you look at weekly wages as opposed to hourly wages. And because there's some difference in hours worked, and you adjust for inflation. So they are finally, like, if you, the way I looked at it is I looked at changes in wages going back to when Biden took office in 2021. And median wages are up a tiny bit, up a lot, or 3 or 4 percentage points for lower income workers, which again is fantastic, and barely up, if sometimes even negative, for higher earners. So, I mean, that's great. That means, I said, inequality has narrowed, but it doesn't mean that, everyone is doing better. And during prior administrations, inequality always worsened, largely because most of the gains did go to upper income people. Like, for instance, there were wage gains under the Obama administration, but as you can see in this picture, the far left is the 10th percentile, and anything below zero are real wage falling. So you see that under definitely with Bush and with Obama, real wages fell for lower income people. But then real wages went up quite a bit for higher income people, which is one of the reasons we had wider inequality. The Trump administration, everyone across the board experienced real wage gains. So that was great, finally. But inequality also widened because middle and upper middle, particularly upper income people, benefited even more. So I guess it's an interesting question in here about, I think, what a society values. Do we care about real wage gains for everyone, or do we care about inequality? We don't necessarily, there's trade-offs to both. And I'm not even saying that they necessarily, I don't think this was the purpose, like the goal of any one administration was to have one, not the other. But it does show that you end up with trade-offs, and what makes a society better off is a tricky thing, and really often comes down to one's individual values.
Yeah, sure. So let's unpack that a little bit. So, yeah, one of the interesting observations you just noted is you say the Trump administration was the only one of the sample there that saw positive wage growth for all income groups. You have a working theory as to why that was?
I think.
Whoops, I think we lost you a little bit there.
On the business
Allison.
cycle. I mean, it took a long time to come out.
Could you repeat that? We lost you a little
sorry.
bit.
I think maybe more on the margin, the tax cuts had some benefit because they were across the income distribution, and largely on the corporate end. But I think the big reason was honestly just where we were in the business cycle. I mean, the financial crisis, that was a really bad recession. It took a really long time to come out of it. And I don't think presidents actually have that much to do with this stuff. And I think Trump just happened to come along when we were really finally fully recovered from the great financial crisis. And I think, that was probably most of it.
Okay. What about productivity? There was some productivity data out today, but the long and the short of it is we have a decent little stretch of encouraging productivity coming out of the United States. We haven't had great productivity in the U.S. for a long time. Does productivity growth correlate in any way with sort of equitable growth across the income spectrum? Could that possibly be encouraging for closing that gap?
It could be. It depends, again, where we are in the productivity cycle. I mean, generally what we've seen from prior boosts of innovation is they do often benefit richer people first, and then eventually, I hate to use the word trickle down because it gets abused, but does eventually like reach other sectors of the labor market. So, I mean, that could be it. We've had a long stretch of very mediocre productivity, which probably has contributed somewhat to stagnant wage growth for certainly the middle class. So I think the hope is, particularly with a lot.
So I think we're losing you a little bit there again, Allison.
See that in the numbers, that we are going to see more productivity, and particularly David Otter, an economist, had a really nice paper speculating that AI would lead to productivity increases for lower income people more than the original round of internet innovation, and that would lead to them having higher wages. So I mean, that's the optimistic take.
Okay. Do you have reason to forecast that declining inequality may continue going forward? What makes you optimistic? What makes you pessimistic?
Well, I personally like to see real wage growth across the board. So I would rather not. It depends what the inequality comes from. The optimistic scenario would be that we have productivity gains that benefit everyone. I would rather see that than a narrowing inequality because we finally have wage gains on the lower end of the labor market, but everyone else is getting poorer. That's not good. It reduces reduction in inequality. So, as I said, the labor market seems remarkably resilient. And if we're seeing job losses anywhere, it is sort of in the upper income levels. That's not good for anyone. It's never good when people lose their jobs. So I think no matter what comes at us, if the labor market holds, then maybe we continue to use technology.
I think we've lost you again there, Allison. Did you want to just summarize that point real quickly? You broke up one more time.
Yeah. Sorry about that. But yeah, I think you could argue that where we are in an innovation cycle, that innovation does initially benefit the wealthy, and that does eventually make lower income workers more productive. So we could just be or that could be where actually like a longer term trend in the next 20 years, we'll be seeing a narrow of inequality and positive real wage gains for everyone, which would be the good thing. We don't want inequality narrowing because some people are getting poorer relative to other people. It's better if everyone has high wage growth.
Yeah, for sure. And here's hoping. Let me turn to this was my assigned theme, but I want to hear what everybody thinks of this. So I was asked to look at, based on the performance of markets, how are we doing here? And the first thing and the most obvious thing to look at, the S&P 500 index of large cap US stocks on a total return basis. And pops out at you as you look at Biden in the dark blue is, for a supposedly unpopular president, the equity market has been doing tremendously well. And always lots of grains of salt, because we're several degrees of separation here, right? To what extent does the administration directly impact the economy? To what extent is the economy the market? And we know that these things are complicated, but by the numbers, this has been a pretty good stretch for equity markets, right? So you now see total returns on the S&P 500 at over 40%, and I should point out that at this exact moment, if you track it like inauguration to date, the Biden equity market is actually now doing better than the Trump equity market. I should caveat that by saying it's a little bit of an unfair comparison, because the Trump performance tails off right around now, because this would have been just around the time when the COVID-19 pandemic was starting, and so you had a crash, and we would subsequently recover from that in grand form later on in the Trump administration. The Trump administration stock market return is still quite impressive, and the Biden administration stock market still needs to do quite well from here to match what Trump did in the full 4 years. But bottom line, pretty impressive run again for a supposedly unpopular president. Now, like, to what extent does this actually reflect policy? I would say probably not a whole lot, right? I mean, some of the features of the Biden stock market, of course, have been the extraordinary outperformance of the so-called Magnificent Seven. I don't know to what extent the Biden administration has been responsible for the bottom lines at Google and Meta and NVIDIA. I would say, however, that the strength of the US consumer has absolutely been part of this. It's been part of it both in terms of fundamentals, right? Earnings per share have remained quite resilient in the US stock market, and confidence among investors, as seen in expanding multiples, has really taken off since I would say probably about early 2023. The equity market is not everything for investors. It's certainly not everything if you, for instance, have a 401k that is something like 40% fixed income and 60% equities, or if you're of a different age, maybe it's 30% bonds and 70% equities, because the fixed income part of your portfolio has struggled during the Biden administration. And you can clearly see that in the dark blue line here. Total returns on the Bloomberg US Treasury Index down about 11% from the start of the administration. I think that this is really just all about what has gone on with the inflation story that Matt described earlier. A lot of that was out of the control of the administration. A lot of that was supply figures. Some of that was Russia's invasion of Ukraine. And I, for one, and I think it sounds like Matt, based on his metrics in the fixed income market, believe that this total return index is probably going to look a fair bit different by the end of 2024. By the time we get the first Fed cut, I think that'll have a big psychological impact on the market, and I don't think we get above zero on this index anytime soon, but I think that the losses probably look a lot more muted. The last thing I would just point out here, and I'm open for debate on this, is you can't look at the dollar index and say that are dissatisfied or losing confidence with America's leadership in the world. The U.S. dollar has been quite strong under the under the Biden administration. I understand that a lot of that is obviously capital flows, right? And with yields high, you might say that brings in money and that pushes up the dollar. But the narrative that the dollar's dominance in global currency markets is like in its waning days is absolutely not borne out by the facts and the performance of this index. Matt, do you agree with that premise?
Yeah, I do actually, and I would add some pieces of data compiled by Bloomberg to support what you just said. If you look, as you just said, of the equity market right now, and you can do this real quick, a function I'm very proud of that I had something to do with way back when called StatGo, which is like a convenient way to get the stats that you're looking for. And you can get the market cap of the 500 largest companies in the world just by going to StatGo. And if you did that right now, which I just did because you were talking, you can see that only 3 of the 20 largest companies in the world are not US. In my 34 years at Bloomberg, we've never had a period where corporate America dominated the world and is worth as much as it's worth as it is today. And that happened in the past 3 years. If you look at this closely, in 2019, Saudi Arabian oil was right at the top. Okay. It's now, and also ran at number 4. Number 1 is Microsoft. Number 2 is Apple. Number 3 is NVIDIA. Number 5 is Amazon. Number 6 is Alphabet. Number 7 is Meta. Number 8 is Berkshire. I could keep going. Corporate America is dominating the world like it never dominated before. And that's only happened in the past 3 years. So obviously something changed. And you mentioned the dollar. Okay, that's a good barometer of where things are, but the dollar could be a reflection of, Fed policy as much as anything. But the fact that you have the equity market where it is and doing as well as it is, and it's, by the way, not just the Magnificent Seven, as I mentioned. You've got companies in here like J.P. Morgan, Chase, Walmart, worth more than LVMH, Moët, Hennessy. And right behind them is MasterCard, and then there's United Healthcare. So you get the idea. Johnson & Johnson not far behind, Home Depot, Procter & Gamble, Costco. Something is happening here that is clearly very beneficial. Now let's turn to the fixed income side, which is what you mentioned before. Look, a lot of the bond market disaster that occurred 22, 23, if you like, was in fact a consequence of what the Fed did, because the Fed raised interest rates faster, more than ever before in a shorter period of time. And that sort of hurt the bond market. But the good news about that is a lot of people who are in bonds with good reason are in tax exempt bonds, are in what we call municipal bonds. To them, that's sleep at night money. And if you look at what happened to, say, Nuveen, which is as good a proxy as any for the tax exempt market, look at Nuveen funds. If you put money into Nuveen at the end of, say, 22, okay, when people were still pretty scared about fixed income and the bond market was in a real deep slide, you're ahead today, actually. You're well ahead today. So, and that's the tax exempt market. Now, it doesn't have anything like the volatility of the treasury market. It doesn't move anywhere near as fast, or as far. But the fact that the tax exempt market has more than held its own from the beginning of 23 to the present, not only held its own, but it's ahead. You have to be feeling really good, because there are a lot of people who would just say, I'm scared about taking risk, and so I don't want to pay taxes, and I just want, a total return that's tax exempt. And so if you look at the tax exempt market right now, bond market looks pretty good too. And by the way, when I see the bond market and the equity market both doing pretty good, to me, that's a really good sign that economic fundamentals behind it must be pretty good too, because to have the two markets working more or less side by side, going in the same direction, which they have been recently, even as the Fed has had a tight credit policy, it bodes well.
For sure. Well, look, we're running short on time here, but I want to start to wind down. I want to thank my two guests, Matthew Winkler and Allison Schrager, very much for being here. And I just want to remind everybody also, please check out this this fantastic package that we put together. I think it's a great preview for the State of the Union. You can look at the Biden administration across a series of measurables here, put together by Bloomberg opinion columnists with a diverse set of views about things and a diverse set of expertise. And you can find it at bloomberg.com/opinion or the @opinion handle here on Twitter or X. So thank you very much for joining us and have a great afternoon.